Recently, Ray Dalio's Bridgewater, one of the largest hedge funds in the world, has started making huge bets on a potential stock market crash. Here's Greg Jensen, the co-chief investment officer at Bridgewater, calling out why he thinks US and European stocks have huge downside from here.
Picture that if you take Europe and the US of this really deepening stagflation environment, this move away, rightfully move away from quantitative easing, but assets have been suspended and in suspended animation relative to the fundamentals because of the constant flow of liquidity from central banks. That has all changed. And that the adjustment that feels abrupt is small relative to how much assets have rallied compared to the cash flows over the last decade due to quantitative easing. So if you think that cash flows need to get in line roughly with the cash flows that support them and that they're not going to be supported by ongoing central bank purchases, you still have very big move in financial assets in Europe and in the US.
So how is Bridgewater positioning itself to profit from this huge downside in US and European stocks? Earlier this month, Bridgewater disclosed a $5.7 billion bet shorting a basket of 18 European stocks. What does it mean to short? By shorting, it means that they're borrowing stock that they don't own and selling it to another buyer with the goal of buying the stock back lower at a later date. Generally, shorting is viewed as a highly speculative endeavor, as a stock can only go down 100%, but the upside risk is potentially thousands of percent over time. Investors may also remember the attempted short squeezes in the last few years, particularly around GameStop, where short sellers were scrambling to close their bets, causing the stock to go up hundreds of percent in January 2021. So when you short, you either need a lot of conviction or you spread your bets across a broad basket of companies. Since then, Bridgewater disclosed that they doubled their European short basket to $10.5 billion and are now shorting 28 different companies. These companies include European titans like ASML Holdings, SAP, and Sanofi. This raises the question, why is Ray Dalio's Bridgewater betting so heavily against European stocks? Here's more from Greg Jensen, the co-chief investment officer of Bridgewater.
Around the world, and there are big issues. Europe's going into a significant recession, probably worse than the US, as a result of everything that's going on in terms of the supply shock there and the war and the impact of that. And at the same time, they're going to have a massive fiscal spending to try to change their infrastructure and rebuild militaries. So you've got stress, significant stress around the world.
Let me explain what Jensen is saying. Europe is facing a lot of pain because historically the European Union depended on Russia for nearly 40% of their imported gas, with some countries like Lithuania, Finland, and Slovakia depending on Russia for 70 to 80% of their energy imports. Europe is losing this vital fossil fuel resource. It's a supply shock, and now they'll need to spend trillions of dollars for alternatives like wind, solar, and hydrogen projects. This is going to cause significant deficit spending in the years and potentially decades ahead. The European Union is already seeing red-hot inflation at 8% plus, so additional deficit spending will make this pain even worse. This is on top of the concerns that there simply isn't enough available supply. For example, just last week, Germany started warning its residents to prepare for gas rationing. When consumers and businesses have to withhold their activities because of a shortage of energy, that can directly shrink the Eurozone economic activity. And what's the European Central Bank doing about all of this? They're out of gas, literally and figuratively. They've already lowered their interest rates to zero and in some cases negative. They see 8% inflation and widening deficits, and their mandate is 2% inflation and price stability. This is an impossible situation. The European Central Bank is nearly powerless, so they resort to talking about raising rates in the future. I suspect Bridgewater is similarly short many large US stocks as well. Why? Even though the US doesn't face the same energy shortages that Europe does because of massive oil-producing regions like the Permian Basin, the US is also working through high inflation. Recently, the US inflation rate reached nearly 9%, and Jerome Powell, the chair of the Federal Reserve, is quickly raising rates to combat inflation. Or as Ray Dalio described,
how does he literally fight inflation? Because everybody says tight money policies, and how do you fight inflation? Well, the way that happens is you get people to spend less by taking money and credit away from them.
Right.
So he will reduce the amount of money and credit that's available. The Federal Reserve is going to sell $1.1 trillion of debt that it has, debt assets, bonds.
Right.
And then they're going to raise interest rates. So they create a squeeze that reduces demand at the same time as people don't have enough money because inflation is high. So
and their buying power is less.
That's right, because inflation is high, the buying power is less. And then what that act is to reduce buying power again, to reduce inflation, but it comes at a big cost. And that is stagflation.
So the US is facing stagflation. This means a stagnant or low growth economy combined with high inflation. This is because consumers are facing both higher prices and less spending power as the Federal Reserve raises interest rates. While Jerome Powell's tighter monetary policies will be very tough on the US economy and potentially lead to a recession and a crashing stock market, it will be even worse for Europe. Why? Global investors realize that they can get higher interest rates in the US over Europe. For example, recently the US 10-year bond was yielding 3.2%, while the German 10-year bond was yielding 1.6%. So capital flees Europe, meaning bondholders and stockholders sell their European assets to get better returns in the US. I'm a fan of Bridgewater because they have a rational framework that explains how the economic machine operates. To summarize, the relevant rule here is that when monetary conditions are tightening, the economy comes under pressure and stock prices can decline and potentially crash. This framework fits with the past century of US stock market data. Here's a chart from John Hussman, an investment manager, that shows the cumulative returns of the S&P 500 since 1940. The top green line shows where there's monetary easing and favorable market conditions. This one investment environment generated the vast majority of S&P 500 returns since 1940. Or if you only invested during a period with monetary easing and favorable market internals since 1940, you would have made over 1,000 times your money. In contrast, the second to worst environment that generated nearly zero returns since 1940 is the red line, and that's the type of environment we're currently in. This is where there's both monetary tightening and unfavorable market conditions. As US and European stocks have fallen, not all investors are leaning into their bearish bets. For example, Howard Marks, billionaire and founder of distressed debt investment firm Oaktree Capital, is aggressively buying while warning investors that waiting for a bottom is a terrible idea. He also said that everything we deal in is significantly cheaper than it was 6 or 12 months ago. Fundamentally, I agree with this approach to investing. The time to go bargain hunting is when stocks are on sale. Investors should rejoice when they can buy great companies at cheap prices. I also agree that trying to time the market is nearly impossible. My challenge to Howard Marks is that comparing an asset price to 6 to 12 months ago can be a terrible idea. What if last year the price was just absolutely bonkers? What if asset prices were ridiculously high last year because of stimulus and radical monetary easing? What if we're only now approaching a reasonable valuation? So while I'm not trying to time the markets, valuation remains a key navigating principle for my own investing. By the way, for exceptional businesses and stocks I find compelling right now, check out unrivaledinvesting.com. So in summary, Ray Dalio's Bridgewater is doubling their bets on a stock market crash with over $10 billion in shorts against European stocks. Why? Global stock prices went crazy high because of past easing and stimulus, and now the Eurozone is in a terrible situation, facing a very deep recession and an energy shock. Their central bank is nearly powerless. This situation is made even worse as the US Federal Reserve is raising interest rates, which also makes Europe a relatively less attractive place to invest. What does this mean for you, and how can you successfully navigate this difficult investment landscape and preserve your purchasing power? My personal view is that these macroeconomic challenges might take years to play out. Bear markets don't typically bottom in weeks or months, but typically years. The favorable conditions that led to prior market rallies don't yet exist. Valuations still aren't dirt cheap, and central bankers are faced with raising interest rates because inflation is just too high. This means investors can either hold cash or try to short like Bridgewater. Shorting is a very risky endeavor, so it's best left to the professionals. With the recession increasingly likely in both the US and Europe, there's also a good chance that valuations can get very, very cheap. Prices that might have looked cheap 6 months ago might still prove to be very expensive. This is the reason why it's so important to size up every investment one at a time, where you're looking at the underlying business prospects as well as the valuation. If you enjoyed this video, please hit that like and subscribe button, and thank you for watching Unrivaled Investing.